Welcome and good morning, everybody, to this Thursday edition of Inside India. I'm Sri Jegarajah. Here are your headlines. Cautious trade in Asia as the Trump administration signals it's open to de-escalating the trade war with China. World Bank, though, is downgrading its growth outlook for India. We will talk about what that means for jobs and the Indian consumer. And Indian markets have been at multi-month highs, but the trade volatility seems to have spooked South Korea's LG Electronics. The company said to have hit the pause button on the IPO of its Indian unit. Welcome, everybody. The Indian markets join us in about 45 minutes' time. Here's what Gift Nifty futures are indicating. We're looking at an opening number in the region of 24,254. So that does suggest a little bit of selling at the open, actually, but the setup ought to look constructive. Judging from what we learned yesterday, benchmarks actually marked their best close for 2025. Nifty put on gains of just under 1% to notch its seventh straight session of gains yesterday. IT stocks were leading the rally after HCL Tech dispelled some of the former gloom surrounding its peers on enterprise spending and released actually a strong revenue guidance. HCL Tech jumped 8%. So let's see if IT can continue to lead the market, given the balance of risks, given the uncertainty, especially with regard to headline growth. And we saw that downgrade to India's headline growth by the World Bank and the IMF to 6.2 and 6.3%. So that may cap gains. Let's take a look at the broader Asian markets. And very clearly, we are not out of the volatility woods yet with regard to the entire tariff narrative. One step forward, two steps back, it seems. And this is really being reflected in the picture in the Asian markets. There is a narrative now about de-escalation and a possible deal with China, although, as Treasury Secretary Scott Bessent has said, in terms of managing expectations, he did say that it was going to be a hard slog. So with that, we have the Nikkei up by 1%, Kospi and the TAIEX and the Hang Seng trailing. Markets hoping for a trade deal between the US and China soon. A White House official telling the Wall Street Journal that the tariff rate could come down to 50% from the 145% currently. This is as the Trump administration seems to be dialing back its rhetoric against China.
China needs to change. The country knows it needs to change. Everyone knows it needs to change. And we want to help it change because we need rebalancing too. America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners.
Some positive signs also coming from the India-US trade negotiations. Now President Trump saying he understands that India will reduce tariffs. India, in the meantime, is considering cutting tariffs on high-end motorbikes to zero to sweeten the deal. And India getting another growth forecast downgrade. The World Bank is projecting GDP to grow at a pace of 6.3% in the current fiscal year. That's down from the 6.7% it forecasted in October. Global economic weakness and policy uncertainty were cited as the reasons for the downgrade. World Bank Group President Ajay Banga spoke to CNBC on the sidelines of the IMF and World Bank's spring meetings, and he talked about the fallout from the trade war, the uncertainty for jobs, and the developments in emerging markets.
1.2 billion in the emerging markets will enter the workforce in the coming 10 to 15 years. Currently, the same countries are forecasted to create 420 million jobs. Now, forecasts are not destiny, but you can change them. But you got to do something about it. That's a very big gap. And the reality is, what's the implication of that gap? One, of course, is migration, fragility, conflict, violence, illegal migration. Second is the whole challenge around the growth of what could be great consumer markets, not just for Western and OECD companies, but also local companies. And so I think getting to the topic of growth and jobs is important. People sometimes think that we talk about jobs, we're not talking about development. Actually, that's a false choice. You can't get jobs without development, and you don't get poverty alleviation and development without jobs.
India is emerging as a huge consumer market, especially for global firms. A report by Bain & Company finds India is shedding its image as a daunting emerging market and delivering returns to global consumer product companies. Spending power has been increasing with the rise of the middle class and working age population. Internet penetration and smartphones have also fueled consumption. India now has the second largest base of online shoppers in the world. However, for global multinationals, challenges still remain, especially in making their approach more India-centric. Let's talk about these challenges and the opportunities. Bring in Ravi Swarup now, Head of India Consumer Products Practice at Bain & Company. Ravi, great to have you on the programme and welcome to Inside India. Let's start with the macro picture first. And is a rising middle-class debt crisis brewing in India, and is it being fuelled by e-commerce, quick commerce, buy now, pay later, especially amongst a younger demographic? And to what degree could that undermine this very strong consumer purchasing power that we have now?
Good morning, and thank you for having me. Well, it's a great question. And if you think about, go back a few decades, India has historically had very high savings rate. So, it's really in the last, 5 to 10 years that private consumption by individual households has actually started to see a significant uptick. So to your question, yes, the digital channels, the digital payments, access to personal credit has actually reduced friction for consumption. But I think we are far away from debt crisis similar to, that may have happened in several other countries. If you look at really the current amount of household debt on an average is much lower and very much within manageable levels. So I don't see this as a possible stumbling block for consumption growth.
And again, though, we are seeing the World Bank and the IMF managing expectations, and 6.7% headline growth seems to be at risk. The new normal for 2025 seems to be in the region of 6.2, 6.3%. In terms of the translation into retail spend, Ravi, is it going to remain resilient, or is there going to be some impact there?
Great question again. When we look at the headline GDP numbers, it hides more than it shows. If you historically look again, over a multi-decade period, private consumption has been a significant driver for GDP growth in India. Now, if you look at the more recent quarters, private consumption had slowed down a bit, but it's been growing back again. So overall, the private consumption contribution to overall GDP growth remains healthy, and going forward as well, we expect that to continue to contribute more and more to GDP growth. The slowdown in the GDP forecast, is largely due to government spend and beyond private consumption.
And Ravi, what are Indian retail trends and demand overall telling us about inflation, the pricing environment, and ultimately who has got pricing power?
That's a wonderful question, very nuanced, can take an hour, but let me try and condense that to a few, key points. First, I think very dominant trend that every consumer company needs to be very prepared for is the channel shift. India has historically been a very traditional trade-dominated country. In the last few years, modern channels, especially relevant for urban India, have actually grown, at 3 to 4 times, their historical rates, and they are growing multiple times faster than traditional channels, which in some categories may actually be, flat to degrowing in urban centers. So that's really one, and by modern channels, I mean both modern trade, which is large chains like Reliance, Retail and DMart, as well as e-commerce like Amazon, Flipkart and the likes, and quick commerce players. So that's number one, the channel shift. While traditional trade will still remain very material and salient, the new channels provide new vehicles of growth for consumer companies. The second shift that's extremely relevant is premiumization, right? So while India is a large country with 1.4 billion consumers, there is a very different segment of consumers at different per capita consumption levels. So the top 10 to 20 million households actually are premiumizing quite heavily, and these are really adopting newer offers, higher price points, and therefore the premium segments across almost all categories are growing at very healthy high teen per CAGRs year on year. So that's number two, which is premiumization is evident across all categories. Number three, is I think greater openness to adopt new offers, new demand spaces, and really, as we think about, India has anywhere between 200 to 400 very well-funded insurgents who are actually driving innovation and creating new offers, creating new demand spaces, and the pace of both innovation as well as adoption of that innovation, whether it's on the back of health orientation, convenience, new snacking options across almost all categories. There is a fairly interesting new set of offers and demand spaces that are growing. Finally, I think I would not be doing justice if I don't talk about the digitization, whether it's of the channel which I spoke about, digital payments, and finally consumers who are exposed digitally to all kinds of stimulus, marketing agendas, and content.
Ravi, the challenge for any retailer operating in India is to be hyper-local and to be specific and relevant to markets within India, which is not just one monolithic market, is it? It's several different markets from state to state, whether it's the northeast to the south. Does the retail opportunity lie among rural or urban consumers?
Great. So let me, it's a great question. Let me give it in two parts. First, to your question on urban versus rural, it's both. Especially developed rural, often, not focused upon by several companies, but actually there is affordability, there is desire to consume similar products or even better products than their urban counterparts are consuming. So rural, definitely, and there is within developed rural, there is affluent rural. That definitely is an opportunity that many companies are, in fact, serving well. Urban, of course, continues to be greater competitive intensity, higher spend potential, higher density of demand, higher, greater degree of channel shifts, and therefore, much higher flux in some senses. If you think about, what used to happen about 5 years back to what's happening now. So therefore, shorter answer, it's both, but different strategies required to address both. To your second question on, customization, that's a big reality of India. We are a large country. Local preferences, customs, cuisines, histories are actually very different from one region to the other. And therefore, that has an impact both on consumer companies as well as retailers. To consumer companies, common large brands do provide economies of scale, but how do you think about your pack price architecture? How do you think about customizing or tweaking variants that are relevant to the local consumers is an important one. And obviously the answer varies differently by categories. For instance, in food, a higher degree of localization that's required because the taste profiles can be quite different, versus in beverages you could have more national plays. Similarly, I think from a retail perspective, yes, the demand density also varies, and the assortment, I would reduce the complexity, right? The top 80% of the assortment can be quite similar, but then you actually have to think about what's your the last 20% of the assortment that is relevant, tweaked to local nuances.
Yes. Ravi, I know that Bain has a professional relationship with Flipkart, but they've been in the news this week for good reason. They announced that they're relocating their headquarters to India from Singapore. And along this theme, last September we heard from Carrefour, which said it was re-entering India. What does this tell you about how businesses are now perceiving the risk-reward in the Indian market? And is this just the beginning, perhaps, of new wave of FDI into Indian retail?
Let me start by saying, one, that it's not new that multinationals are making winning plays or significant plays in the country. If we look at we studied about 25 categories, and more than half of those categories actually had a multinational which was in the top two position. So therefore, there are multinationals that have been winning in consumer categories in the country. Having said that, if I reflect on the conversations we have been having with our clients, whether it's consumer companies or retailers, they are extremely conscious of the fact that 70-75% of growth going forward will come from emerging markets, and India as an emerging market is an absolute must-win if they want to actually achieve their 10-year ambitions, growth ambitions. And therefore, secondly, it is increasingly important to actually have a multipolar centers of gravity as you think about growth, and really it's almost become given that you really have to play to win in the Indian market. So the stance that I have seen our multinational clients take towards India has increasingly been more and more aggressive over the last, in fact, more recent times. Lastly, to your question, is this an early sign of FDI coming in? I wouldn't be able to comment on the financial markets, but from a strategic perspective, I am seeing significant investments being planned. But from my perspective, I think there needs to be more, just to tap
Understood,
into the opportunity.
Yes. Is it possible, though, for large retailers and the mom-and-pop Kirana stores, Ravi, to coexist?
Oh, absolutely. And we have researched a lot with consumers. There is omni-channel buying consumer. There is a role that the local Kirana, the traditional store, provides. There is familiarity, convenience. There are, depending upon the shopping mission, channel choices are made. So there is room for everyone. But there is, of course, the need for even the local Kirana to reinvent itself, be more consumer-oriented. There is a home delivery that many of them do. There is personalization that many of them do. They actually know the consumers better than the larger players. So net-net, there is room for everyone. In even, you look out 10 years, 20 years, 30 years, all of these channels will coexist. Each of them will have a different role to play in the life of a consumer.
Is quick commerce a bigger threat to Kirana stores from as opposed to the larger retailers? And what's your take on quick commerce, Ravi? Is it a fad? Is it the next big growth opportunity? And from a ethical point of view, is it wrong to put sheer pressure on the delivery drivers as these delivery times get tighter and perceptions of consumer expectations become even higher?
That's a great question. I can share my views. Of course, many of the earlier held views have been proven wrong, as many of these quick commerce players have scaled. I do see quick commerce is here to stay for two reasons at the highest level. The consumer value proposition is proven beyond doubt. The consumers care about convenience. Indian kitchens are small, working capital is limited. Therefore, the shift from stock-up shopping missions to actually, on-time purchases has actually is irreversibly made for several categories and for several shopping missions. So that's number one. Number two is that the players themselves have found profitable, or let's say semi-profitable models to service this consumer insight. So that's number one. To your question, is this likely to remain? Absolutely. It's relevant to consumers, and now there is a viable method for this business to operate. To your question number two.
Ravi, just very quickly, because we have to wrap things up. And again, this is on the back of Commerce Minister Goyal's point. Can retail, or is retail moving up the value chain to the point where it is creating quality jobs in e-commerce, programmers and coders, as opposed to delivery boys and girls?
Oh, absolutely. If you think about any of the e-commerce and quick commerce companies, the amount of innovation that has happened in operating models on the tech structure, tech stack, on the business model itself, on the warehouse management practices. These are groundbreaking innovations that will scale to other businesses eventually. So I do think that there's actually a very significant innovation and tech innovation as well that these business models have actually created.
Ravi, you've got to wrap it up there. It's been great talking to you. Thank you very much indeed for your insights and the outlook on India's retail and e-commerce sector. Massive growth opportunities, but challenges as well. Ravi Swarup there from Bain and Capital. We're back in 2 minutes. Welcome back. After a horrific terrorist attack on tourists in India's Kashmir, the country is significantly downgrading its ties with Pakistan. India has accused Pakistan of supporting cross-border terrorism. The punitive measures against Pakistan include a suspension of a key water sharing treaty and the closure of a border crossing.
1. The Indus Waters Treaty of 1960 will be held in abeyance with immediate effect until Pakistan credibly and irrevocably abjures its support for cross-border terrorism. 2. The integrated checkpost Atari will be closed with immediate effect. Those who have crossed over with valid endorsements may return through that route before 1 May 2025. 3. Pakistani nationals will not be permitted to travel to India under the SAARC visa exemption scheme visas. Any SVAS visas issued in the past to Pakistani nationals are deemed cancelled.
In the meantime, Pakistan's finance minister attending IMF spring meetings. He also spoke to CNBC's Caroline Ruth about how Pakistan is planning to leverage its copper reserves in tariff negotiations with the United States as it walks a tightrope between the US and China.
As far as the tariffs are concerned, for US exports into Pakistan, the weighted average tariff is around 7%. The Pakistani exports into the US, the weighted average tariff is about 10%. A number of products that we actually get from the US, including cotton, is already zero. So I think that's number one. And number two, it's really more about the trade imbalance. So we export a little over $5 billion. We import roughly $2 billion plus. And we think, from our perspective, as the delegation arrives here, because our Prime Minister has said a high-level delegation will be there to constructively engage with the US administration, that we have an opportunity to close this gap. We are already importing a lot of high-quality cotton. Can we do more? The answer is yes. We are already importing some agriculture commodities, including soybeans. Can we do more? Yes, we can. And we can add a few other asset classes. So I think that in itself, from a narrow trade and commerce bit, from our perspective, it appears to be manageable. Having said that, as a finance minister, I would say it's the larger canvas we should be looking at. And a US delegation was in Pakistan around our minerals and mining conference, and especially with respect to copper, because as you know, copper is going to be playing a very important transitional role in terms of the energy transition. And it's also going to go into a global shortage. The Tatian belt in Pakistan is our supply side answer to that shortage. So we think when that engagement takes place, given that US is also looking more access into rare earth and metals like copper, that we can have a wider discussion as well.
In the meantime, are you pivoting more towards China? And is the US still a trusted ally?
From our perspective, US has been a very strategic partner, one of our largest trading partners, and therefore we want to very constructively engage with the US. And China has been there with respect to Belt and Road, also a very long-standing relationship. From where I sit and from where our government is at this point in time, it's an and discussion. This is not an and or discussion.
It's not either or.
No, it's an and discussion. Both are very critical and strategic allies for Pakistan.
Coming up, LG Electronics is delaying its India IPO plans. Is volatility keeping investors away from new listings? We'll take a deep dive into where India is currently investing with Vineet Arora of NAV Capital. Stay with us. Asian markets are showing a fair degree of dispersion. On the positive end of the ledger, the Nikkei is up by almost 1%. However, on the negative end, the Hang Seng is down by 1.4%. This continues to be a global stock market, and Asia is no exception here. That's being bullied around by the tariff headlines right now. The narrative seems to be one of a de-escalation, but clearly some corners of the APAC markets are not running with that particular narrative and are still trading very cautiously. And we are counting down to the market open in India. As far as the futures picture is concerned, this is how we are shaping up. GIFT Nifty futures are indicating an opening number in the region of 24,266. So that does suggest a wee bit of selling at the open, but the setup ought to look constructive. The benchmarks yesterday actually marked their best close for 2025, and the Nifty put on just under 1% to notch its 7th straight session of gains. But there are a lot of cross currents in these markets, especially with IT stocks, which led the rally yesterday after HCL Tech impressed the market with its strong revenue guidance, but its peers have been upsetting the apple cart to a certain degree because of some gloom surrounding enterprise spending, their exposure to the US markets, and this narrative about layoffs, which tells you a lot about where we are in the cycle in that particular sector. Right, in the meantime, mining giant Vedanta is mulling a listing in the United States. A company owned by Indian billionaire Anil Agarwal is reportedly looking to list its Zambian unit on the NYSE. That's one of the options the firm is exploring to raise $1 billion for mine development, and we'll be watching shares of Vedanta Resources when the Indian markets open shortly in just under 15 minutes' time. Now, while Vedanta plans to list, LG is hitting pause on its India IPO plans. South Korea's LG Electronics reportedly delaying its IPO for its Indian unit due to market uncertainty. The listing was originally scheduled to take place in May, but it's now targeting to launch in the second or third quarter of the current fiscal year. No final decision has been made, and shares are taking a hit in South Korea today. Market volatility also not settling well with Indian e-scooter maker Ather Energy. Ather is now planning to list at a valuation of up to $1.4 billion. That's down 44% from its original target. The company has reduced the number of shares on offer in its IPO owing to global market volatility and tariffs, but it could still be India's third largest IPO this year. Let's talk more markets with Vineet Arora, Managing Director at NAV Capital, joins me now. Vineet, thank you very much indeed for your time, and thank you for joining us on Inside India. Just walk us through the opportunities that you see in India's SMEs and pre-IPO companies, which are the mainstay, aren't they, of the Bharat Investment Opportunities Fund?
Thank you, Sri, for having me here. See, if you look at India's landscape and the way the shift has been happening over the last few years with government pushing on Make in India, it's the smaller companies which become very, very important for India to achieve its vision of 2030 in terms of the growth of the economy. And that's the segment we focus on, the companies which are direct beneficiaries of government's push towards manufacturing. For example, if a Foxconn has to come up and set up a large assembly unit in India, it needs a lot of smaller companies to come around, which prosper alongside. And those are the kind of companies we focus on. We do a lot of pre-IPOs primarily, especially if you see last 2 years, the Indian markets have been kind of on a tear, barring last 6-8 months. So the valuations became a bit high, the markets were a bit frothy, and that's where, in the pre-IPO space, you're able to negotiate valuations much better and get a larger stake in companies, which you can't get in an IPO frenzy. Whatever you apply for, you're going to get a minuscule portion. And especially when you go towards the hinterlands, forget Mumbai or the metropolitan cities. When you go to tier 2 and tier 3 cities, there are a lot of these smaller companies where the promoters are not very soft. They're not very sophisticated in terms of the markets, whether it comes to capital markets or making a presentation to a PE or a VC fund. And that's where, you kind of handhold them, guide them, mentor them, and take them through the process. And that's give you a significant alpha over the larger companies.
Do you feel that the mood is cooling with regard to the appetite to take the plunge and go for an IPO? We got this news flow with LG Electronics delaying its India IPO unit, and e-scooter maker Ather said it will pursue its IPO but will do so at a lower valuation. What is that telling you about appetite, Vineet?
If you talk of Ather or LG, these are very large IPOs, and the valuations are fairly high. If you look at the smaller companies, yes, the mood has tapered off a bit, especially last few months of the downturn has hit the small cap index, pretty hard, and that's usually always the case. But I think appetite is still there. If what has happened, which is a good thing, is the valuations which are going through the roof will correct now, and they'll become more reasonable and palatable from an investor's perspective. So I think after a few months of lull, we'll start seeing activity again. We've already seen merchant bankers approaching us for the IPOs, which kind of had almost stopped for the last 2-3 months. So we've seen it. We're starting to see the trickle down in terms of merchant bankers, investment bankers meeting funds and trying to gauge the market and the mood. And I think gradually it'll come back in the next few months.
I see. When you look at the drawdown from the highs in the public markets, Vineet, what did that tell you, and how much of a ripple effect did that have on your fund? And is that, have we seen the worst of it, or is there another continuation of that mid-cycle adjustment coming?
So if you look at Indian markets, I think the fall, which went unnoticed, started in July when the capital gains tax and STT was increased. It gathered speed in September and beginning October with long China, short India trade becoming the fad. And then, of course, Trump came in and tariff discussions started happening. I think Indian markets have been the first one to come back to the pre-announcement levels once the tariff were announced, and kind of they are trading above that now. They've almost erased the losses for the year. So, markets were getting battered for much longer than the global markets. In US, we started seeing the fall towards mid-Feb onwards is when the steep correction happened. But India was already suffering for 6-8 months. Of course, Jan and Feb were brutal in India. And I've been saying, sometime in the beginning of March that we are close to the bottom now. There's not much downside left, and this is the time to actually start moving in, start nibbling on the stocks that you're wanting to buy. In small cap index saw about a 20% correction during this year, first 2 months of the year. But more importantly, the smaller stocks which don't fall part of the index, there were falls of 50, 60, 70%. And suddenly they became very attractive. And we've seen a pullback happening over the last few sessions significantly.
You say that the fund is sector agnostic, but how do you feel about IT services? Because we've been getting a lot of very mixed signals from the earnings season. HCL Tech really impressed the market, but its peers did not. There were, and there continue to be, some very real concerns about a fall-off in enterprise demand in the North American markets that Infosys and Wipro are exposed to. How do you feel about IT services at this juncture?
When you look at IT services, companies like Infosys or Wipro, it's largely outsourcing of the back-end work or some development work. That will remain to be slow and subdued. But if you try and find the niche segments within the IT services, there are enough good stories available. And I include even the SaaS platforms towards data centers or data centers part of the larger IT framework. So we've invested in few IT services companies, but we've been in the niche areas of softer skills training or corporate trainings, which is more tech, AI, machine learning driven. We've done cybersecurity. We're investing into a company which is into authentication of blockchain contracts. We've done data centers, we've done SaaS platform on data centers, cloud computing. So if you look at the niche areas, there's money to be made. But broadly,
Yes.
IT services, what we've seen traditionally, I think it'll remain a bit of drag.
Yes. There's so much dispersion, isn't there, as far as the macro and the markets picture and the outlook is for the Indian markets. We've had the World Bank and the IMF downgrading the headline growth forecast, and we had a really interesting conversation earlier on the programme with Ravi Swarup from Bain and Company, talking about e-commerce and retail and FMCG. From a SME and a pre-IPO point of view, do you like the story, Vineet, associated with retail and the Indian consumer, or are you concerned about all this global economic uncertainty ultimately weighing on purchasing power, as well as the household debt?
India has traditionally been an inward-looking economy and very low reliance on debt, barring the new generation which piles on debt. In general, Indians are averse to any form of debt. And it's a consumption-driven economy. So while it does get rattled by what happens in the global market, but eventually, what we call the Hindu rate of growth, there's certain growth in population happening and consumption happening, and that continues to happen. We've seen FMCG kind of having a tepid growth over the last few quarters. I don't see kind of a bull run happening there, but you always can find niche areas which are growing faster, which are shifting along with the consumer demand. I don't see domestic debt or retail debt as much of an issue yet. RBI was ahead of the curve when they started clamping down on retail lending, buy now, pay later platforms, etc. So I think we are fairly well positioned from that perspective vis-a-vis other global large economies. Whenever you see there's a global situation happening or global crisis happening, of course, India will fall with the pack, but usually it comes out stronger. And that's my personal opinion. When the tariff war or the whole debate settles, India will be in a much better position than what it was before the discussion started. Largely because it's been a neutral country. They've been the first one to approach US. We had Jerry Vance in India, already negotiating a treaty. So I think India should be doing okay.
Vinny, can I bring in Sebi at this point? They last year tightened the rules for smaller firms looking to list publicly. They're also toying around with the idea of imposing a profit floor for companies looking to IPO. Do you feel that there needs to be an overhaul, a rethink, a re-examination of the regulatory framework as it applies to SME IPOs by the regulators and by Sebi?
I think if you look at the total amount the SME companies have raised, it's negligible as compared, over a 12-year journey of the SME exchange. And the way I look at the regulator's job is to actually act as an enabler and not really act as a policeman and stop curtailing the markets. Sebi went, I think, a bit too far last couple of years in terms of taking that everything on its own. But I think with the new Sebi chief coming in, we are getting feelers that Sebi is looking at it proactively. They're more receptive now. You can't put archaic norms like 2 years free cash flows to a small company which is actually growing and needs capital. It will not have free cash flows. I mean, somebody needs to look at those, some archaic norms which have been put in place and revisit them because here you're killing the sector before it's born. But my sense is, sanity will prevail. We've already seen some correction and kind of stabilization happening.
Yes.
And Sebi is looking at the norms again.
Vinny, what do you make of Q4 earnings so far? Is it a story of resilience and growth, or is there evidence of uncertainty, capital spending being slowed down or even just frozen completely? We've seen the layoffs in the IT services space. How concerned are you of guidance risk as it applies to your wheelhouse, as it applies to SMEs?
SMEs in general will do better than the larger companies. But we do see in some sectors capital spending being curtailed, which actually is very much required. I think last 1 year capital spending across sectors has been low, and that does has a ripple effect in the economy, whether it comes to infra or any other field. Uh, I think the results are going to be a mixed bag. Some companies with good managements will outshine despite the challenges, and some will lag. So one has to be careful and continuously realign the portfolio. The biggest challenge in the small cap and micro cap segment is data sets are very sparse and few. So you have to actually do a lot of due diligence in terms of continuously being in touch with the management. You can't wait for the quarter or half year to end to take a decision. So, there's the softer aspects that you continuously monitor, take your decisions. Like I chat with four, five
Yes.
founders in a portfolio every day, on a casual basis. What's happening to this contract? What's happening to this machinery? Has the production started? So you get these softer signals in terms of where the company is going before the data sets come out. And
Yes.
that's what one needs to do.
Vinny, I can't let you go without talking about the bilateral trade agreement and the prospect of an India-US trade deal. It feels like India is in the front of the queue because of the alliance and the proximity and the relationship between President Trump and Prime Minister Modi. We just had J.D. Vance visiting, and President Trump may be next in terms of high-profile visits. What does a BTA mean for India's SMEs?
I mean, it does have an impact, especially SMEs, if it's a favorable agreement towards India, where the manufacturing gets a boost, and we see some shift away, more shift away from China and Vietnam, where Trump has been kind of against. The manufacturing will get a boost in India in terms of companies shifting their production base here. On the high precision tooling side, engineering side, India has a lot of talent available. So the smaller companies will definitely benefit. I always say no large cap was ever born large cap. They were once upon a time a small company which have kind of grown consistently to become a mid cap or a large cap company. And that's a segment I believe will benefit the most out of the tariff war. I strongly believe India will be one of the first few countries to get a favorable agreement signed, and the trade will come normalize very soon again. In terms of U.S., India ranks 10th in terms of trade with U.S. So India is not a very large trading partner for U.S., but a critical trading partner in terms of China plus one trade. I think we will see that
Yes.
happening. We've kind of I've seen some Chinese companies talking to Indian companies to do a full technology transfer
Yes.
to the Indian counterparts. That why don't you start manufacturing here? I mean, we've got a few examples in a portfolio as well. So you can sense that shift happening. Uh, of course, China is way ahead when it comes to the manufacturing capabilities. They've taken it to a different level. But even a small trickle for economy like India would be a huge boost.
Vineet, on that note, we'll leave it there, sir. Thank you very much indeed for joining me. Vineet Aurora there from NAV Capital. Coming up the programme, Indian markets have joined the trading day. We'll look at what's moving the markets and also heading to the Shanghai Auto Show. All that after this short break. Right, Indian markets are well into the trading session. Let's give you a glance at the Nifty 50, and it is off by about 0.2%. So maybe there's some evidence of profit taking after what was a very constructive day yesterday for the Indian benchmarks. In fact, the Nifty 50 had its best close of 2025. It was up just under 1%, but it was really IT services that were driving the confidence in the broader market. So it'll be interesting to see how they're performing today. This is after HCL Tech impressed the market with their guidance, which was something of an outlier, a positive outlier, given the fact that a lot of HCL Tech's peers were quite pessimistic about the outlook, especially with regard to enterprise spending, especially with regard to a potential growth scare in the key US market. Right, let's take a look at some of the movers. Let's take a look at shares of Tata Consumer Products, and this is how they are performing after the consumer goods major beat quarterly revenue estimates. The stock, however, down by 2.5% thanks to higher sales and higher prices in its domestic food and beverage segments. It has been diversifying and investing in distribution to help offset muted consumption growth in urban India. And the earnings parade continues in India. These are the companies reporting today. Hindustan Lever, Nestle India, Axis Bank and Tech Mahindra stocks are looking like this, all trading in the plus column. But it's very clear to see that when you look at the trading action, the market action today, there are some very positive stories here. And that is the expectation of de-escalation, the entire tariff narrative. There is a sense that India is at the front of the queue with a bilateral trade agreement with the United States, but there's no getting away from the concern about a global slowdown, and India is not immune from that. So perhaps it's these downgrades by the World Bank and the IMF that is really capping the gains and taking the gloss of what we saw yesterday. Right, in the meantime, Vietnamese automaker VinFast is planning to open its factory in India by the end of June, its CEO said earlier this year. It was reported that VinFast will enter the Indian market with 2 premium electric SUVs. Right, let's keep it in the mobility sector, and let's also take a look at the Indian auto stocks. They are trading like this. Again, they are at the sharp end of the tariff situation. The White House confirming. There you go, that's the picture there. Looking somewhat mixed, but overall positive. The White House confirming to CNBC that President Trump is considering exemptions for automakers on some tariffs. Lin is getting a pulse check at the auto show currently underway in Shanghai. And Lin, just give us a sense of the sentiment over there.
Good morning to you, Sri. It's great to be with you. Certainly, this is the annual car show in China, the largest auto show in the world. And so you've got a lot of exhibitors here really eager to show what they've got to update their potential customers on. So there is certainly a buzz here. However, there is that overhang given the trade and the tariff situation. And, you know, this news that potentially the White House could be looking at some sort of a partial back down in terms of the tariff situation would be welcome news for basically all of the automakers here. Let me take you through what they are potentially considering. This is potentially exempting a tariff on car parts from China, and this is the 20% that was imposed because of the fentanyl production, and potentially as well including the levies on steel and aluminum. But as I said, the 25% on foreign vehicle imports into the US as well as parts, that is still intact, and that is still going to be a major concern here for the OEMs. And they're dealing with that double whammy, right? The tariff situation and the fact that particularly for the foreign automakers, they have been losing market share in the biggest vehicle market in the world. And on that front, we have really seen a pushback by the likes of the Japanese, the Europeans, to try and win back the Chinese consumer as well. Sri.
Lynn, excellent. As Scott Bessent has said, it's going to be a hard slog towards a US-China trade deal. Thank you very much, Lynn. That's it for today's edition of Inside India. Tomorrow we will hear from Capital Land's lodging unit Ascot, betting big on India and expanding its portfolio there. Also, we'll do a deep dive into the macroeconomic picture with Kotak Institutional Equities. Don't miss that. That's all the time we have today on Inside India. Stay with us at CNBC. Access Middle East with Dan Murphy is coming up next.